Hello guys, once again welcome to our YouTube channel Edu Hub, and our next course will be stock market investment and trading for absolute beginners, so please don't forget to share video to your friends and family members for support me. So without wasting time, let's get started. Stock market investment and trading for absolute beginners part 1.
Hi, as I welcome you to this course, Comprehensive Understanding of Stock Market for Beginners, let me give you a preview of what to expect from this course. Let me tell you that while I am hosting this course today on Udemy, I already have a few courses, these 3 and these another 3, a total of 6 courses related to finance, investment and the stock market already there on Udemy, and these courses are doing well. I have received all favorable, positive and constructive response from my students. Students have appreciated these courses. But I have received a common feedback, or rather a request from my students, asking me to prepare a comprehensive course giving a broad understanding of the stock market so that they can get a general idea as to what a stock market is and how does it function. Now their point of view, my students' point of view, is that a general course about the stock market, like explaining what a stock is, who are the players in the stock market, how does the stock market function, all these answers will help them in better understanding the stock market and better understanding the focused courses. Alright, so that is the reason I have come up with this course. Actually, this course is dedicated to all those students, my students, who have enrolled for any of my course till date. That is today, 9th December 2021, when I am hosting this course for the first time. And these students have provided me constructive feedback, encouraging me, or rather compelling me to come up with this course. Certainly, I owe them a big thank you from the core of my heart. Now let me give you a preview. I have structured this course into 4 sections. The first section is Know the Stock Market as a Play Field. The second one is Knowing the Players and how they play the game. The third one is about knowing the parameters and the rules of the game. And then we have a section for add-on lessons. Let me explain. The first section, Know the Stock Market as a Playing Field. Here I have tried to describe the stock market as a playing field. First of all, knowing what you do. Most of us just jump into the stock market, start investing or trading without actually knowing what we are doing. So we'll talk about that. Then we'll talk about the concept of a share, equity and debt. Thereafter, something about shareholders, shareholding and the capital structure of a company. Then the concept of an initial public offer, a follow-on public offer and how their pricing is done. Then we'll talk about the concept of profit, dividend and growth. Then the primary and the secondary market and how a trade happens in the market. Then we'll talk something about the depository participant, the clearing house, and how do we start investing in a stock market. Then the logic of the market price fluctuation and how to place a buy and sell order. The market price keeps fluctuating. We'll try and understand the logic of that. Then in section 2, we shall try to understand and become familiar with the players of the stock market and how they play the game. You see, when you enter the stock market as an investor, you are not the only one in the stock market. There are many other people with different intentions, different agenda, and they influence the stock price in different manner. Various players affect the stock price in different manners. We'll talk about the investor and the trader, who are the main players. Then we'll talk about something known as arbitrator. Who are these people? What do they do? Then something about a hedger, or the hedge funds as we normally call them. And then something about the big players like the financial institutions, the foreign institutional investors, the domestic institutional investors, and some high net worth individuals. Then we'll talk about some players who play from behind the curtain, like the news channels, some analysts and panelists on discussions over the news channels. And then something about this person called as the speculator. Really, I did not want to speak about speculation, but I think you must know about it. Therefore, as a second thought, I included that. Then in the third section, we'll talk about some parameters and rules of the game. When you enter the stock market, you should know certain things. In the first step, we shall talk about what role would you like to play. Like we have seen about various players in the previous section. In this section, we will decide what role you would like to play, a trader or an investor. All right. And then we shall talk something about the fundamental analysis. And within the fundamental analysis, we shall talk something about the significance of financial statements, then the stock parameters and some ratios of the stocks. Then we'll talk something about the technical analysis. And within technical analysis, we'll talk about the candlestick charts and patterns, their significance, and some technical indicators. And then we will also talk about derivatives and risk management using these derivatives. Something about futures, options, and hedging. But please remember that I will be giving you only a broad-based knowledge about these things. I will not be going into too much of detail. Obviously, because these are specialized topics, we have separate courses on these subjects. But just as a general understanding for you to set your mind thinking, we will be talking about these things. So once you go through this, do not be disappointed that I have not talked about them in detail. If you want to understand in detail, then for each of these things, we have a separate course. All right. Then this last section called as add-on lessons. Now this is something, a new concept I want to try. What I believe is that a stock market is a never-ending story. This is a subject which can never be complete. Focused courses can be completed, but talking general about the stock market can never be complete. But I have to end somewhere. So therefore, what I have done is, in this section, my intention is to encourage students to ask me questions. And then I would post my answers to their questions in the form of small video lessons in this add-on section. So over a period of time, this section will keep on building up. As the students keep asking me questions, this section will keep on building in the form of my answers. And if the student asking a question provides me her or his name, photograph, and the country of residence, and if they permit me to, display these things in the answers, I will be very happy to do that. But I request that the questions should be related to the stock market and should be knowledge seeking questions. Please do not ask me tips and tricks or recommendations about some particular stocks or things like that. Ask me general questions which, look towards seeking knowledge, not tips. So we begin this section actually empty. without any lessons. But as my students keep asking me questions, this story will continue. So let us begin with this course now. Hi, it is a known fact, and you also must be aware that a large population across the globe indulge in stock market investment or trading. But unfortunately, most of the people do it without understanding the basics or the concepts of how the stock market functions. People normally buy shares hoping that the price will increase, and they sell the shares when the price goes up. But if the price does not go up, then they get stuck with the stock holding for years together. They are reluctant or not willing to sell the shares at a loss, and therefore, for years together, they remain stuck with their holdings. But they refuse to spend time in understanding how things work in the stock market. Why do people invest or trade without understanding what they actually do? What is the reason for indulging in stock market without adequate understanding of the subject? The reason is that when people try to understand stock market as a whole, it seems quite a complex subject, quite a complex thing. People get confused and they give up learning. But when you try to understand only what is a stock or a share, then it is very simple to understand. And then when you try to understand why should there be a market for buying and selling stocks, then again it becomes a very simple thing. Thereafter, when you put 2 plus 2 together and try to understand stock and market together, the stock market becomes a very, very simple thing. So in this course, what we are going to do is, we shall first understand in detail what a stock or a share is. We shall understand the various characteristics and the types of shares, and also why should the price of shares change from moment to moment and day to day. Then we will try to understand what is the need, or why should there be a need for buying and selling shares. And then how does this buying and selling happens. Now once you understand all these things, then a clear picture of stock market emerges, and it becomes very easy for you as to how things work in the stock market. So when you try to learn stock market as a whole, it is a complex thing. And when you understand stock and market separately, then the whole picture becomes very, very clear. Hi. Now to begin with, let us try and understand what is a share. To understand this, let us consider that 5 friends have gone for a picnic and they decide to buy a pizza. The pizza is costing $12. So what they do is they contribute whatever money each of them have in their pocket. And that is how they contribute $10. So whatever the total money they can pool in is $10. Somebody has contributed 1, somebody has contributed 2, somebody has contributed 3, and that makes a total of $10. They are still short of $2 to purchase that pizza. So what they do, they borrow that $2 from some nearby money lender and then purchase the pizza. So in the simplest words, this $10 which they have pooled in is called as the equity. The $2 which they have borrowed is called as the debt. So now what is the share? To understand that, let us see how they divide the pizza among themselves. They'll have to divide the pizza into equal and distributable portions. Try and understand these two words. Equal. Every piece has to be equal, and it also has to be distributable, in the sense that if there are 5 people here, it shouldn't happen that you divide the pizza into 6 pieces or 4 pieces. They have to be distributable. Alright. So they divide the pizza into 10 equal pieces, and each portion or each piece of that pizza is called a share. So what each one of them gets? Aston gets 1 share, Bob gets 2 shares, Charlie gets 3 shares, and so on. Alright, depending upon how much they had contributed. So that is how the whole pizza gets distributed among the people who had contributed for it. So now here the total shareable contribution is called as the equity. What was that total shareable contribution? That was $10. Alright, that is equity. And the borrowed money, the $2 which they had borrowed, is called as debt. And each equitable or the equal portion of the pizza is called a share. So now what I have just explained to you is conceptually what a share is. Now this concept we shall apply to the stock market and the industry as we proceed, and then we will see what is the relevance of equity, what is the relevance of debt, and what is a share in the stock market. Alright, now having understood what is equity, what is debt, and what is a share, let us try and understand something about shareholders, shareholding, and the capital structure of a company. Alright, so in the previous lesson we have seen that those 5 friends wanted to buy a pizza. Now their ambitions have grown, and let us say that they want to start a garment manufacturing company, and the requirement of money to start that company is $20 million. Alright, they want to start such a company which requires $20 million. So what they do, they contribute whatever each one has got, their lifetime savings, they contribute, and they come up with $10 million. Alright, somebody pulls in 1 million, somebody pulls in 2, somebody 3, and together they are able to manage $10 million. The requirement is 20, so they are still short of $10 million. What will they do now? What they do is, these people so far who were calling themselves as friends, now they call themselves as promoters, and they formulate a company, a notional company, not actually notional, but on paper they establish a company, and they call that company 5 Friend Garments Limited. They can call it anything. Let us say that they call the company as 5 Friend Garments Limited, and they become the promoters of these company. Promoters means the people who have started or are starting this company. Alright, now this company 5 Friend Garments Limited, this company will approach the bank and ask for a loan for the remaining $10 million. Alright, then they have been able to manage for the remaining money. The promoters cannot ask the bank. The promoters, of course, since the company cannot walk up to the bank, the promoters will go to the bank on behalf of the company, but the loan will be asked by the company or for the company. Alright, and the bank will see the collateral guarantee. The bank will ask the promoters what collateral guarantee can the company give, and the promoters will say we have got a small piece of land, we can place that as a guarantee. So the bank says, okay, we can offer you a maximum of $2 million as loan, as debt, not more than that. And you will have to pay us 10% interest on this amount. So they accepted, okay, let us manage 2 million more. Now they are still short of $8 million. Alright, their requirement was 20, 10 they have been able to manage, 2 they have taken as loan from the bank, still short of $8 million. So what do they do now? They come up with an idea. As they had done for the pizza, what they do now, they divide the entire company into 1.8 million shares of $10 each. All right. This company, which is still on paper, they are dividing it into 1.8 million small pieces, each piece costing $10. Why 1.8 million? Because remember, we had talked about that the share has to be first of all equal and then distributable. All right. Since they want $18 million, 10 they have already been able to manage. They want 8 more. So the requirement is $18 million. Therefore, they divide it into 1.8 million shares, each share costing $10. All right. And they ask the public. Before they ask the public, they themselves pick up the shares depending upon how much they have contributed, each of them. The person who has contributed $1 million will pick up 0.1 million shares. The person who has contributed $3 million will pick up 0.3 million shares, and so on. All right. So a total of 1 million shares are picked up by the promoters themselves. Why 1 million shares? Because together they have contributed 10 million. So 1 million shares they pick up. And now they invite the public. They ask the public that whoever can pay $100 can take 10 shares of our company, and you also become a stakeholder in our company. All right. So 0.8 million shares are available for the public to take. Anybody can take those shares. Just pay minimum of $100 and pick up 10 shares of this company. All right. And then they become a stakeholder. There is no difference between the promoters and the public shareholders, except that the promoters are having a larger number of shares. The people or individuals who are buying from the public, they may have a small number of shares. That's all. But otherwise, in terms of each share, everybody is equal. Okay. Now, you see, we talk about the capital structure of the company. So we know that 2 million is the debt. This they have borrowed from the bank. And the remaining 18 million is the equity. Out of this 18 million, 10 is with the promoters and 8 is with the public. But the entire amount is equity. As I have told you, there is no difference in the equity held by the promoters or the equity held by the public. It is one and the same. So 2 million debt, 18 million as equity. The total capital of the company is now 20 million. They can make the company function now. They can build up the infrastructure, purchase the machines, start their work. All right. Now there is something called as the debt equity ratio. Debt is 2 million, equity is 18 million. So the debt equity ratio of this company, Five Friend Garments Limited, is 1:9. All right. Just imagine if the debt was 5 million instead of 2 million, if the debt was 5 million and equity was 15 million, then the debt equity ratio would have been 1:3. And another scenario, let us imagine that the debt was 10 million and equity was also 10 million, half. All right. In that case, the debt and equity would have been equal, 1:1. What is the significance of this debt and equity? That we have discussed in one of our other courses, which is about the fundamentals of finance, investment and business. I have explained in detail over there. But this debt equity ratio basically signifies the risk being carried by the company. As we proceed in this course, we will also touch upon this further. All right. Now, there is something called as the shareholding of the company. We know that the public now is holding 0.8 million shares and the promoters are holding 1 million shares. All right. So promoters are holding more shares. The public are holding lesser number of shares. So out of the total 1.8 million shares of the face value $10 each, 1 million are held by the promoters. That means the promoters are holding 55.6% of the shares. They have a majority shareholding. The promoters have got a majority shareholding. And the public have got 44.4% of the shares. it is not necessary that the promoters have more than 50% of the shares. The promoters can have less number of shares also. But the point is that the promoters have started the company. They want to retain the control of the company. Alright. Therefore, a good promoter will always try to retain more than 50% of the shares so that they retain the control of the company. Alright. Now, try and understand this. Very important. Please recollect who has borrowed the debt of $2 million. Have the promoters borrowed that money or the company has borrowed that money from the bank? Just think over. The money has been borrowed by the company, not by the promoters. So, whose responsibility is it now to return that money? This debt has to be paid back by the company, Pipe and Garments Limited, and not the promoters. The promoters have not taken this loan or the debt. It is the company which has taken the debt. Alright? Please remember always, as long as you want to be in the stock market, always remember that the company, the owners of the company, and the management of the company, all three of them are separate entities. They are not one and the same. The company is an entity in itself which has borrowed the money. Alright? Owners of the company, these promoters and the shareholders together, that public who are holding 0.8 million shares and these promoters who are holding 1 million shares, together they are the owners of the company. Alright? Together they are the owners. Each shareholder, even if is holding one share, 1 out of 1.8 million stake he has got in the company. So even if you are having one share, you can still call yourself as a very, very, very small owner of the company. The owners of the company can participate in the management. They can become board of directors. Since the promoters have got lot many shares, they can become part of the management. They can become board of directors. But still, the ownership and the management will remain separate. Alright? So now, the shareholders are entitled to receive the profit. If the company generates profit, the shareholders are entitled to receive the profit in the same equitable and distributable amount. Alright? Whatever, the share of the profit the promoters will receive, the same amount the other shareholders will also receive the same equitable amount per share. Alright? But the shareholders, including the promoters, they are not liable to repay the debt. This $2 million which has been borrowed from the bank, the shareholders are not liable to return that debt. Shareholders means, again I repeat, the promoters as well as the public who are holding the shares. So these people are not responsible to repay the debt. Who is responsible? It is the company which is responsible to repay the debt. The company will earn profit. Out of that profit, the company will pay the interest on the debt or return the debt. And then the balance profit which remains belongs to the shareholders. Alright? So the company will give profit only after paying all the dues and taxes. Dues means the interest on this borrowed amount, and any other person who is entitled to receive the money, who has lent the money to the company, they will first receive the money, the government will receive the taxes, and then the profit which remains belongs to the shareholders, the promoters and the public shareholders both. Alright? How the profit is generated, how the tax and debt is paid, how the shareholders get their dividend, all these aspects are important for you to understand if you have to remain in the stock market. And all these things we shall be discussing as we progress. Alright? Hi. In this lesson, we shall talk something about the process of IPO, FPO, and something about their pricing. You may be broadly aware as to what an IPO or an FPO is, but my request is, do not skip this lesson. Try to go through it and understand it conceptually. You may find it very simple, even childish, but that is how the concepts are explained, and it is always good to understand the concepts. So, if you recollect, in the previous lesson, we have seen that the promoters could manage to pool in $10 million. $2 million they borrowed from the bank, and they were still short of $8 million to start their business, and therefore they invited that money from the public. They asked the public to contribute and become a stakeholder in the business. All right. So this offer of shares which the promoters made to the public, inviting them, asking them to become a stakeholder in their business, that process is called as the IPO, or the initial public offer. Why initial? Because this offer is being made by the promoters of this company for the first time. For the first time, they are inviting the public to become a stakeholder. Therefore, it is the initial public offer. And this process of offering the shares to the public is called as the public issue of shares. The event is called as the initial public offer, and the process is called as the public issue of shares. Now the question is, why are the promoters offering the shares to the public at the same price of $10 per share, the same price at which they themselves are taking the shares? The answer is that in the beginning, when the company is yet to establish itself, when the company is yet to begin its business, at that time, the promoters and the public are on the same footing. The business has not yet commenced. We do not know how the business will perform, what is the future course of action. So therefore, the public and the promoters contribute in the same manner, the same amount per share. All right. So in the beginning, when the company is yet to begin its business, the worth of the company is $18 million in terms of equity, divided into 1.8 million shares of $10 each. All right. It could be $10, it could be $1, it could be $2. Accordingly, they can have the face value and the number of shares. All right. Out of this 1.8 million, 1 million shares are held by the promoters because they have contributed $10 million, and the remaining 0.8 million is held by the public. So 8 million will be contributed by the public, and 2 million, of course, is the debt taken from the bank. Clear so far? All right. Now let us imagine a situation. Just hypothetically consider that the promoters pool in $10 million, all right. 2 million they borrow from the bank, that is also okay. And let us say that they start their business with $12 million without taking any contribution from the public. All right, so they are not coming out with a public issue, no IPO at this stage. With a lesser amount, with $12 million, they start their business on a lower scale probably. Maybe they will purchase a few less machines. Maybe they will hire a few less number of people. Maybe they will have little less land. But with $12 million, they start their business. So to begin with, the worth of the company is 10 million in terms of equity, and this entire equity belongs to the promoters. 2 million in the form of debt. All right. No shareholding by the public. So far the public have not come in. All right. And over the next 5 years, this company generates a lot of profit. And every year, a small amount of profit the promoters take for themselves as dividend, and a major portion of the profit they reinvest in the company for the growth of the company. Alright, so whatever profit they make, a small amount they share among themselves as dividend, and a large amount of that profit they reinvest back into the company. So, and that is how over the period of 5 years the worth of the company increases. Initially what they had contributed as 10 million, over a period of 5 years that 10 million becomes 25 million, let us say. Alright, it becomes 25 million. And of course the 2 million of debt which they had taken continues. Every year they are paying an interest on that debt. Alright, so therefore the shares which were initially valued at $10 per share, the face value, their face value still remains $10, but their worth in the books become $25. Alright, because this 10 million have become 25 million. So the share which was worth $10 in the beginning now has become worth $25 in the books. In the books means in the books of accounts, in the balance sheet. The market value may be different, but on paper in the books that share has now become $25. The face value remains 10, but its actual worth becomes 25 on paper. Alright. Now the company wants more funds for their expansion plans. The company wants to increase their manufacturing capacity and export the garments to the other countries. So far they were making or manufacturing garments for the local requirement. Now they want to increase the capacity and export the garments. Alright. So what will the company do now? They require more funds. 25 million they already have, but they require more funds. So now at this stage, let us say the company wants to go public. They want to come up with an initial public offer for the public. They want to offer shares to the public. 1 million shares they are already holding at $10 each. Now they want to offer additional 0.8 million shares to the public at this stage. Alright. Now remember, the face value of the new shares will remain the same, $10 per share, because it is the equity. Equity means everybody holding the share is equal as far as the company is concerned. One share, one vote. Alright. So whether it is the promoters who had taken the shares earlier or the new public which is now entering, all are at the same footing. So therefore the face value of the new shares will also remain $10 per share. But the question is, will the company offer the shares to the public at the same initial price? Face value will be $10, alright. But will the offer price be the same? For the past 5 years, the promoters have been working hard. They have been slogging to establish the company. Now the company has been established. It is doing good. All the hurdles are cleared. So would the promoters want the new public to enter at the same initial price? Certainly not. They would not offer the shares to the public at the same price of $10 per share, though the face value will still remain 10. So what they will do, the company will offer the shares to the public through the initial public offer at a face value of $10 plus some premium, some additional amount for various reasons. And what are those reasons? What will this premium depend upon? The premium will depend upon several factors. The first and the foremost thing is the difference between the book value. The initial investment by the promoters, which was $10 per share, in the books it has become $15 per share. Alright, the face value is 10 itself, but 15 is the additional growth which has taken place. So therefore First of all, the promoters would want the public to pay that difference. So $15 per share is because of the book value they'll pay additional. Apart from that, the business is already up and running. There is a lot of confidence in the business. When the business initially started, there were a lot of question marks. All those question marks are eliminated. The business is well established now because of the hard work of the promoters. So would the promoters not want the public to pay for the hard work which has already been put in? Certainly. So let us say they ask for additional $10 for the confidence in the business. Then the business is already having a loyal clientele. They already have customers. Less effort will be required now. Less struggle will be required now for marketing and making a niche for themselves. So for that already available loyal clientele, the premium would be, let us say, $10 per share. This the company would want to get from the new entrants. All right. What we are talking, these values, they are all hypothetical at the moment what we are discussing. It is not decided at random. Quite a complex process. It is decided, the premium is decided by the lead managers to the issue who are expert in this field. But just for the sake of understanding, we are taking these hypothetical figures. All right. Okay. Now, apart from the loyal clientele which the company already has, the company is now wanting to export the garments. So far they were making for the local customers. Now they want to make it for export. So the export modalities have been worked out and there is a lot of scope for huge profit in export. And for all this, the promoters have done the hard work. So therefore, the promoter would want some premium for that also. Now let us say $15 as premium for this particular aspect. And then the company has established itself as a known brand. People in the market know the company by its brand name. So the company has a brand value. And for that brand value, let us say the company is asking for a premium of $20 per share. So there can be few more things which may come up to your mind or which may come up to the promoter's mind. But the fact is that the offer price now, the offer price will comprise of the face value plus some premium. And what we have hypothetically worked out here is $68 per share as premium. So the offer price in the IPO will be, let us say, $78 per share, comprising $10 as the face value and $68 as the premium. All right. Now let us see what the worth of the company is after the IPO. So first of all, if we consider the IPO, we have seen that 0.8 million shares have been offered to the public and the face value of those shares is $10 per share. So 8 million has come in the form of equity. And then the same amount of shares, 0.8 million shares, have also attracted a premium of $68 per share. So $54.4 million have come in the form of premium. All right. All this will now go into the company's balance sheet. How? Let us try and understand this. Let us try and understand the equity, reserves and surplus under that. You already know what the equity is. We have discussed. The amount, face value of the shares contributed by the promoters as well as the public, that is the equity. Then what is the reserves and surplus? See, this reserves and surplus I have already explained in one of my other courses, which is about understanding the financial statements. But notwithstanding that, let me explain to you in very brief. See, every year the company earns some profit. Out of that net profit, any good company will not give away the entire profit as dividend. A small amount they would distribute as dividend and the remaining amount they will reinvest into the company for expanding the business or for the growth of the business. And that money which gets reinvested goes under the head of reserves and surplus. And secondly, when the company, offers shares at premium, this premium amount would also go as reserves and surplus. So ultimately the equity and the reserves and surplus, this entire amount belongs to the shareholders. All right. Earlier, before the IPO, the amount belonged only to the promoters. Now, after the IPO, this entire amount, equity plus reserves and surplus, belongs to the entire spectrum of shareholders, the promoters as well as the public. All right. And debt, you already know what has been borrowed from the bank or other institutions, that is the debt. All right. So now let us see the worth of the company. In the beginning, when the company started, that time the equity was 10 million, pooled in by the promoters. We know that. And there were no reserves and surplus because the company had just started. There were no profits, so reserve and surplus were nil. And 2 million, of course, was the debt. Then just before the IPO, if you recollect, 10 million was the equity of the promoters and 15 million was the reserves and surplus. You remember I had said that 10 million has grown into 25 million. So the equity remained as 10 million and that growth of 15 million comes into the reserves and surplus. And 2 million, of course, the debt remains. Then just after the IPO, now after the IPO, we know that 10 million was already there of the promoters. 8 million in the form of equity has now come in from the public, this 0.8 million shares, all right? So that makes an equity of $18 million. So the new equity of the company is $18 million. And the reserves and surplus, we already know that 15 million was the reserves and surplus before the IPO. 54.4 million has come in the form of premium, so that goes in as reserves and surplus. So the total reserves and surplus becomes 69.4 million. Now this entire amount, 18 million plus 69.4 million, this entire amount belongs to the shareholders. Shareholders means the promoters and the public together. This is the entitlement of the entire shareholders. All shareholders have equal stake on this amount. Got the point? And of course the 2 million debt which the company had taken, that remains. Now the question which you may ask me is that why should you know all this? What is the point in understanding all these intricacies of the IPO? The answer is that for a comprehensive understanding of the stock market, you need to know all this. Only if you understand these concepts, you will be able to understand how the stock market functions. Stock market does not only mean buying and selling shares based on tips from somebody. You have to know the intricacies and the entire process of how things function. All right. So now this is just a portion of the IPO what we have discussed. We shall continue this in the next lesson where we shall talk about the FPO and also about the pricing of IPO and FPO. All right. Okay. So now continuing from the previous lesson, let us proceed further, a step ahead. All right. Now we have seen that the company was into manufacture of garments and they came out with an IPO to garner additional funds. They want to now export the garments also. And the company is now flourishing in the export of garments. All right. So in the next 5 years after the IPO, the equity of the company remains the same. 10 million from the promoters, 8 million what they had collected from the public. That equity remains the same, 1.8 million shares of face value $10 each. 1 million shares held by the promoters, 0.8 million shares held by the public. But in the next 5 years, the reserves and surplus keep on increasing. Why? Because every year the company would earn profit. Some profit they'll take as dividend, and the balance of profit they will reinvest for growth of the company. So the company keeps growing, and the reserves and surplus over a period of 5 years, let us say it comes to 150 million. All right. And the debt becomes zero because over the next 5 years after the IPO, the company would gradually repay that debt. Now it has got adequate money, so it does not want to keep debt from the bank. Over a period of 5 years, they repay the entire debt. All right. And now the company wants to diversify into manufacturing and export of sports equipment. So far, it has been exporting garments. Now they want to diversify. They want to manufacture and export sports equipment also. And for that purpose, they require additional $100 million. All right. 150 they already have in that kitty. 150 plus this 18 million they already have. They require 100 million more to diversify. Okay. So what they will do? They again want to offer additional shares to the public. 0.8 million shares they have already offered. They want to offer additional shares to the public. So they will come out with a public offer again. But what will that public offer be called now? It will be called as the follow-on public offer or the FPO. Same thing, but you cannot call it as initial public offer because initial is the first time. That first time is over. Company has already taken first time for entering into exports of garment. Now this is the second time when they are asking for the public money. So therefore it is called as the follow-on public offer. Maybe they'll come up again for the third time. Again it will be called as a follow-on offer. Maybe the second follow-on offer. All right. And how will this follow-on offer be priced? In a similar manner as what has been done during the IPO. The face value will still remain $10 per share, but the premium may increase depending upon various factors. How much the company has grown, what are the future plans of the company, and the same factors what we had discussed during IPO. Considering all those things, the premium may be much more, but the process in principle remains the same. All right. So now when an IPO or an FPO comes, there is a lot of enthusiasm in the public. Okay. Though the IPO or the FPO are offered at huge premiums, but still there is lot of demand. People want to subscribe for these IPOs, thinking of getting some money at listing, making some gains at listing. All right. If a company is operational, if the company is already running, and then it is coming up with an IPO, it would mean that so far before the IPO, all the shares were held by the promoters. All right. There were no public shareholding. Only the promoters were holding the share. And therefore, now for the first time, they are offering shares to the public. IPO. All right. We shall discuss only the IPO because IPO and FPO, the process remains the same. All right. And during the IPO, they are wanting more money by offering additional shares to the public. Why this I have written in capital additional, we'll discuss a moment later. All right. So the first thing that you must see while subscribing to an IPO is whether the premium which the company is asking is justified or not. All right. So the shares will always be offered at a face value plus premium. And the face value plus premium together is called as the offer price. So whether that offer price is justified or not. Face value of course is justified because it is the same for the promoters as well as the public. But is the premium justified? What will the premium depend on? We have already discussed that premium will depend on these things. The difference in the book value, how much is the confidence in the business level, how many loyal clientele are there, how much is the market share of that company, what is the scope of profits in future, has the company established itself as a brand name, is it known to the public, various other things. But the fact is that it is very, very difficult for common people to evaluate these aspects and decide whether the premium is justified or not. Normally what people do is they go by the recommendation of the experts on the TV channels. But the question is, are these recommendations always non-biased? There is a question mark in my mind. So what I would recommend is, as common people, what we can do is, we can look at three major aspects of an IPO and then make a judgment whether the premium is justified, whether it is worth investing in the IPO or not. And these broad three major aspects are, first of all, we need to know as to what the company wants to do. And then what about the promoter holding and the debt status? Let us discuss individually each of these aspects, which is very easy for the common man to find out. All right. So the first thing, what does the company want to do? Does the company want to expand the current business? If the company wants to expand the current business, then that would mean that the demand for the current product already exists, and then only the company is wanting to expand. So it is a good sign. You can think of investing in this company. All right. Only if there is a demand for the current business, the company would want to invest more. But if the company is wanting to start something new, then there is a question mark. You will have to see how much is the risk involved in the new business. For example, say, let us talk about the same company, Five Friend Garments Limited. Now they were making the garment. The first time they wanted to increase the capacity for making garments to export the garments. So as far as I can think, the confidence level was high. The same business they were doing, they wanted to expand the same business. What they were supplying locally, now they wanted to export. So it sounds good. But when they were coming up with an FPO, they wanted to diversify. Their niche area is manufacturing garments. But from that, they want to diversify into sports equipment. Are they experienced in making sports equipment? How much is the confidence level? What is the risk involved? So I would see it with some suspicion. All right. I hope you understand the general decision making logic. Then the promoter holding. Now you see, in our case, initially the promoters were holding 1 million shares at $10 each, that means 10 million, and the public was holding 0.8 million shares. That means the contribution or the share of the promoter was more. So therefore, it builds in confidence that the promoters are holding a major stake. So therefore, they would not do anything which will harm the company. All right, so they'll take care of the company. So if the promoter share is further increasing in the IPO or the FPO, if the promoters themselves are further contributing, then it is a good sign. It increases the confidence level that the promoters themselves are putting more money. So why shouldn't I? All right. But if the company or the promoter share remain the same, if the promoters are not putting anything extra, they are not putting anything more with the public, then okay, it is not bad, neutral. All right. But if the promoters are offloading their shares through the offer for sale, sometime you may find that the IPO or the FPO has got a component called as offer for share. Like in our case, the promoters were holding 1 million shares. Sometimes the promoter may offer to offload or sell off their own shares. Out of 1 million, they may be wanting to sell off, say, 0.2 million shares during this IPO to the public. But that is not a good sign. if the business is doing more, if the promoters are very confident about the business, if the promoters feel that the business is growing to grow further, then why would the promoters sell their stake in the business if the business is doing good? So therefore, when you find in an IPO document that there is some offer for sale, the promoters themselves are selling off a portion of their holding, then you must look at it with suspicion. Why is it that the promoters themselves are selling and they want the public to buy? A question mark. All right. And then the debt status. You see, the company has some debt. In our case, it was a very small amount, just $2 million. It could be more also. Sometimes the debt could be 50-50 also. Debt equity ratio could be 1:1 also. Now you have to see whether the company is using the IPO money to repay the debts. That will be mentioned in the document. If they want to do that, they have to disclose it. But then the question should come into your mind as to why the company is borrowing money from the public, or not borrowing. Why is the company asking a stake from the public and then repaying the debt? Because if you recollect our lesson in one of the other courses about the debt equity ratio and the financial leverage, if the debt is working good for the company, if the company is earning a profit more than the amount of interest which it has to pay. For example, if the company is paying an interest on debt at the rate of 10% and the company is earning profit at the rate of 15%, then why would the company want to repay the debt? All right. The company would want to repay the debt only if its profit are turning out to be less than the amount of interest which it has to pay. And the company is not able to tolerate paying that interest. For example, if the debt is at 10% interest and the company is making only 8% profit, that means from the shareholders' money, the company is paying the additional 2% interest. All right. So therefore, if the company is taking money from the public to repay the debt, it should be looked at with suspicion. It is a tricky question, a question mark. You have to be very careful while investing in such a company which is asking money from the public to repay the debt. And lastly, sometime you may find that the company is incurring losses. After its inception, for a few years, the company keeps on incurring losses. And still it comes out with an IPO at a premium. They are themselves incurring losses and they are selling now, offloading or probably asking people to contribute for the shares at a premium. Is that justified? Often you would have seen in the market that IPOs come at a premium, but the company is loss making. Now you need to understand this. You see, when a company starts, most of the time when good companies start their business, they invest a huge amount. All right. Let us say this is vertical y-axis is about the money and the x-axis is about the time. All right. So a company invests a huge amount, and for a few years, the company will keep on pumping money and sustaining losses because they are making a customer base. Initially, the company may sell their products at a loss to make a huge customer base. They will invest a lot of money in marketing, advertisement, making the infrastructure. So the company keeps on going into a loss. They keep on incurring a loss till a particular time. Okay. And at this particular juncture, the company is now ripe. And from next year onwards, they are in a position to make profits exponentially. All right. They have taken this couple of years, maybe 2, 3, 4, 5 years to make their base, establish a customer relationship, incur a lot of losses, but now they will come up with a bang and make huge profits. So therefore, you have to see that whether it is a good business which in the normal circumstances have incurred losses for making their foundation strong, for making a good customer base, or is it by default a loss making company? All right, you have to see that. And then before investing, see, you have to see where you are investing. You are investing at this juncture, at this juncture, at this juncture, at this juncture. Accordingly, the premium will be different. If you probably want to invest at this juncture, the premium will be still more because now the company is profit making. All right. But whatever the case may be, before you invest in a company which is a loss making company, you have to see the three aspects which we have discussed in the previous screen. All right, all those three aspects. And more important, or the most important, is the promoter stake. Are the promoters increasing their stake, keeping their stake unchanged, or reducing their stake? If the promoters are reducing their stake, then please remain away from such a company. Why would you and me want to invest in a company where the promoters themselves are wanting to get out? All right. So I hope this concept of IPO, FPO, and broadly their pricing is very clear to you. Actually, we should have discussed this topic towards the end, but in the flow when we were discussing it, I found it very appropriate to discuss this topic here, and therefore we have taken this lecture at this juncture. All right. So after having discussed the capital structure and the concept of debt and equity, let us now try and understand the concept of profit, dividend, and growth. Now, to understand this, let us try and answer the question as to why does a person want to invest in shares? Why would you and me want to invest our money in the stock market in shares? All right. Now, it could be for the purpose of getting a periodic repetitive income. For example, let us say I invest a capital of $1,000 in shares of some good company, and then I expect that I should get some regular income from this after every 3 months or 6 months or maybe every year. And at the same time, while I keep getting regular income from this, I would want that the value of my capital should not reduce. My capital should not reduce below 1,000 what I have invested, and at the same time it should keep giving me some regular returns. Now you may call this as dividend income. All right, we will see more about it little later. The other reason could be for the purpose of capital appreciation. For example, say I invest a capital of $1,000 in some good shares today, and then I expect that in a few years the value of my investment should become much more than $1,000. I won't mind if I don't get a regular return, but after a few years the value of my investment should be much more than $1,000 which I have invested. Okay. Now this you may call as growth of your capital. First we have seen was a regular income, which is the dividend income. In the second case, I am not expecting a regular income, but I am expecting my capital to grow. Or it could be for a combination of both. For example, say I invest $1,000 in shares of some good company, and then I expect that I should get some regular income out of it, and at the same time in a few years my $1,000 of investment should grow substantially much more than $1,000. All right. So what I am expecting is a combination of dividend and growth. Now, before we understand the concept of dividend and growth, we need to understand profit. And understanding profit is quite a complex thing. It is not so easy to calculate profit. But we are not doing a course of some chartered accountant or anything like that. Therefore, I shall try and explain to you in very simple words, in very layman's language. Alright? So now you know that any company which is producing goods or services, the company would incur certain expenditure on producing those goods and services over a period of 1 year. And then the company would generate revenue by selling those goods and services. Alright? First, the company incurs the expenditure, and then by selling the goods or the services, the company generates a revenue. And in simple words, the revenue minus the expenditure is something called as EBITDA, or the earning before interest, tax, depreciation and amortization. Now, if the revenue of the company is more than the expenditure, then this EBITDA will be positive. But if the expenditure is more than the revenue, then this will be a negative EBITDA and it will be called as a loss. Let us try and understand what this EBITDA is. Okay. So for a given year, let us say our company, the Five Friends Garments Limited, has earned an EBITDA of $6 million. Okay. The revenue minus expenditure for a given year is $6 million. Now, from this $6 million, the first thing that the company will take out is the depreciation and amortization. Let us say the depreciation and amortization is $1 million. Now, what this depreciation and amortization is, you may not bother to know about it at this stage. In fact, this depreciation and amortization I have explained in detail in one of my other courses that is about understanding the financial statements. But just for your understanding, let me explain to you very briefly. Let us say that the company purchases a machine or a software costing $7 million. Now this is a big amount. If this entire amount the company were to show as expenditure in one particular year, then that would be a huge expenditure and the accounts will get disturbed. So therefore, the government allows the company to spread this expenditure over a period of time, depending upon the accounting policy of that country. Let us say the cost of the machine is $7 million and the company can spread it over 7 years, and the life of the machine is also 7 years. So every year the company will write off $1 million, and that is how over a period of 7 years the company will take out $7 million. By that time the amount would have been recovered and the machine would have completed its life, so the company can buy a new machine. If it is a tangible asset like a machine, then what we are doing is called as depreciation. And the same thing if done for a non-tangible asset like a software, then it is called as amortization. So I think that much of understanding will do for the time being. But the point is, in depreciation and amortization, the company has taken out $1 million out of this 6. Okay. Thereafter, the first thing the company has to do is pay the taxes to the government. The government will not leave the company without paying the taxes. So let us say $1 million, hypothetically, this figure is hypothetical. Let us say $1 million goes towards paying taxes to the government. And thereafter, once the taxes are paid, the company has to pay interest to the lenders for the borrowed money. Whatever money the company has borrowed from the lenders, banks or other financial institutions or the public, the company has to pay interest on that. for the given year. Let us say the interest paid is also $1 million. All right. Now out of this $6 million, 1 million gone as interest, 1 million as taxes, 1 million taken out as depreciation and amortization. So what remains now is called as the net profit. So this net profit will be 3 million. Out of this 6, 3 is taken away. So 3 million remains as the net profit. And this entire net profit belongs to the shareholders. Who are the shareholders of the company? The promoters as well as the public shareholders. Okay, we have seen this already. So this entire amount of 3 million now literally or rightfully belongs to the shareholders. But the point is, will the company give this entire money of 3 million to the shareholders, or will it do something different? What should a good company do with this money? This we will discuss in the next lesson, or the second part of this lesson. All right.